All right, so you guys have asked me so many questions about can I help with the analysis of markets and stocks. And I just thought I'm going to do if you listen to my videos and you watch my videos, which are now coming through in a very strategic manner, morning, afternoon, evening, you will slowly, if you watch them, get an understanding of how the markets work and how I think about the markets and how professionals think about the markets. And that's the idea here, for me to try and help you understand the way professionals trade this market whilst at the same time helping you make money. But I just this is a very, very long subject, but I'm going to do little videos from time to time to try and give you snippets of how I think about markets and the things that the retail universe don't necessarily understand about markets. So today's comment is about the structure of markets and who's trading them, why they're trading them, and how that's different to the way it was, for example, when I started in this business in the early 2000s. And even more importantly, back in the 1980s and 1990s, and how prior to 2009, when quantitative easing was invented, and how things changed from that moment onwards. So pre-2009, we had much more traditional old school markets, right? Of course, we had the tech bubble of 1999, and we had a lot of exuberance and all that kind of thing. But the construct of markets was completely different. First of all, the markets that were the stocks that were leading the indexes, the market cap weighted indexes, were completely different types of companies. You know, these were more traditional companies with debt on the balance sheet and more cyclical earnings, things like banks and energy companies, insurance companies and oil companies and all these kind of companies. The likes of the Mag 7 didn't exist back then, right? That changed the game forever in terms of the leaders in the index. But more importantly, not more importantly, equally as importantly and interestingly, is the macroeconomic environment. Prior to 2009, which of course was when the IMF got together to come up with quantitative easing to combat the financial crisis, there was no such thing as quantitative easing, right? The monetary policy toolbox was raising interest rates, reducing interest rates, and then of course fiscal spending or fiscal austerity, right? That was it. It's very simple. Then quantitative easing came in, where the central banks decided they can come and buy government bonds, corporate bonds, and risky bonds if they need to. And that changed the game. It put a floor under all these massive events. Let's just take COVID, for example. What an incredible example. If you look at the charts of the NASDAQ, right, going back to 1999, watch them in the lead up to the 1999 bubble, the sell-off, and then look at from 2009 up to where we are now. Those sell-offs and those market moves back then are completely irrelevant in comparison, right? It's completely changed the game. So quantitative easing came in, not only did it artificially keep interest rates down, but it also meant that in situations like COVID, for example, when those who were trading markets or not understanding markets would have read the headlines and seen the price action and gone, the world is ending. And that's what the professionals have to do, that because it's risk management. It happens every single time. It happened just the other day with the Trump tariffs, right? But more from an economically sensitive situation. The COVID is a great example. What did the central banks do? They came in, they started buying government bonds, they started buying corporate bonds, and then they eventually started buying junk bonds, right? They essentially came out and said, we will buy anything and everything to support the market. So it's no wonder that there are these recessions and market sell-offs don't last very long. If you throw on top of that the machines, the algorithms, the passive money, the CTAs that buy momentum and sell momentum and follow momentum, and higher and lower, and then the retail cohort, which is you guys, globally, are a massive, massive, massive amount of money. I mean, just take the Robinhood crew, for example. I mean, I think there's something like $200 billion or something globally of retail money. Imagine if they're all pressing buy at the same time. These guys, most of them don't sell or short anyway. They just buy things. So the whole, and then they're using options and short-term options, which sometimes daily options, which means that the dealers are constantly having to cover themselves, which causes the gamma squeezes higher and higher. So if you throw this all into the basket, it's no surprise that we have, and then of course the Mag 7, which is driving, these companies are now completely and utterly different to anything we've seen before, right? They're multinational, multi-trillion, huge profit, EPS growth, revenue growth, innovation, dominance globally, economically they're not economically sensitive, right? Even in downturns, people are still buying their products and using their products. They're not capital intensive. They've got no debt on the balance sheet. And these companies are multi-trillion-dollar companies, so it's no surprise that the indexes find it difficult to sell off, because whenever they do, the high-quality companies are bought and back up we go, right? The S&P 500, 7 of those stocks makes up almost 50% of the entire index. So it's not an index of 500 stocks, is it? It's an index of essentially 10, 15 stocks, right? It's not, the rest of them are irrelevant. So the whole construct of the market has changed dramatically. So from a macro point of view, that's one of the huge considerations that I have at all times. And that's just, I'll leave it there on that subject for the time being. And then in tangent to that, of course, it's very important to have a complete bottom-up understanding of all these companies, and that takes time. I've followed markets now for 22 years. I started as a mining analyst. I was in Hong Kong doing Asia, ex-Japan, and then Japan. Then I sat in Europe and did Europe. And then for the last 10 years, I've focused my attention on tech and the US, but I speak to my clients about absolutely everything in the world. But tech and US is where all the action is, and that's where my focus really is most of the time. Nonetheless, I've had probably 600 companies in my universe that I follow. Very closely, maybe more than 1,000 that I've got on my screens. There's plenty of stocks that I don't know, but I'd like to think that I know pretty much all the ones that are worth trading and have liquidity, certainly the ones in the tech universe. I obviously have all my sources. I think Seeking Alpha is one of the most fantastic and underrated sources in the world of information. You can do a free membership to them, or you can do the pro service. Either way, the news flow, the access to buy side. The best part is it's written by people from the buy side, not the sell side. It's not investment banks selling you research. It's hedge fund managers and hedge fund analysts writing research and giving you their insight, in-depth, fantastic color on pretty much any company in the world, mostly US to be fair. Nonetheless, sources like that, along with my Bloomberg and all my other sources and my own knowledge of these companies, it all comes together. And that's why when I come for an idea that I put in my book and I share with you guys, this isn't some random stock. This is a company that I've known for years and years and years and followed the price action, followed the story, and feel comfortable. It's all about knowing the stock, knowing the company, and knowing where it is, right? Where the positioning is, where their earnings are. The whole story comes together. If you looked at a screen, if you're new to markets, it's very, very difficult to get a feel for anything, right? So that's what I'm going to try and gently share with you. I hope you've had the patience to listen to this, and I hope it's not too long. I'll do many more of these, but that's just a small introduction to what I do and the way I think about markets and the way that markets have changed over the years.